use them to identify trends, patterns in supply and demand, as well as the basis of their forecast. We also widely see that the governments refer to our assessments across all commodities, various commodities, when formulating royalty payments, as well as retail prices, and last but not least, commodity exchanges, clearing houses, financial institutions also rely on our price benchmark for listing, trading, and clearing purposes. So, to make it short, our works helps the market function efficiently by providing transparency into the market via multiple credible benchmarks that support decision making across the commodities. Yeah. So let's move to our renewable certificate coverage. It's not just limited to IREX, but I just put IREC here because it's our main interest for today. Our offerings in the REC markets not just limited to IREC, but it cover global certificate as well, includes European guarantees of origins as well as the US RECs markets. And for the IREC market specifically, our coverage spans across India, Malaysia, Vietnam, Thailand, Singapore, Brazil, Chile, Mexico, Turkey, and Saudi Arabia. And within APAC, as I mentioned before, our main focus markets are India, Malaysia, Vietnam, Thailand, and Singapore. And we actually are also in the process of launching the Australian LGC assessments by the end of this month. So keep an eye out on it. Yeah. So the technologies that we cover is different across countries. So these technology selections are actually based on the market feedback, the market liquidity, and the trading volumes in the markets. Because we observe that different markets have different availability across technologies as well as different buyer preferences. That's why we have different offerings of technology across different markets. And then moving towards to the core of today's presentation, is market insights. I'll be touching on the Indian market first, then I will continue with Singapore and Malaysian market price dynamics. So I purposely choose these two countries because Malaysia and Singapore are eventually impacted by PPA and VPPA. So the trend from this country might also become an interest to Indian participants or as a reference or a baseline in the future for the Indian market when VPPA and PPA started to become mature in the Indian market in the future. And especially with the current ongoing development of VPPA framework in India that was announced last year. And let's start with the issuance and redemption dynamics in India. I start with the redemption first. As you can see in the chart, the redemptions had grew strongly in 2025, and according to feedback that we received, it is supported by sustained voluntary corporate demands uh, uh, from the market. The redemption increased last year by around 60% year on year to around 14 terawatt hour. However, the state of the market is actually remains in an oversupply state because we saw that issuance continued to outpace redemption by more than redemption growth, more than 60% actually, and it keeps the market structurally long and oversupplied. On the demand side, the feedback that we receive from the market is that the corporations continue to expand their decarbonization efforts, particularly multinational companies with supply chain exposure in India, especially RE100 related companies. And the renewable procurement activity was positive in 2000 to that, through 2024 and 2025. Uh, it reflects a continued growth in demand for credible EAC. Within the Indian market environment, IREX remain the sole flexible and scalable instruments, helping companies to offset their scope 2 commitments, particularly in this market when direct PPAs and VPPAs are not that mature enough and attractive enough to the buyers. On the supply side, we saw that the renewable capacity growth is the reason Is the fundamental driver why the issuance grow quite strong as compared to redemption. So last year alone, India roughly at 40 gigawatts of renewable capacity. And although issuance momentum slowed slightly in 2024 as in the chart, mainly due to the reduced hydro issuance and stricter regulations to prevent double counting from the local issuer, we saw that the issuance pick up again in 2025, driven mostly by a lot of solar project commissioning. That's what we hear from the market. And at the same time, there's the hydro project issuance remain relatively muted and limited because based on the feedback that we receive, majority of them are redirected for hydro power purchase obligation purpose. Therefore, no issuance for hydro for IREC. The market is currently in surplus state, which means that there is a lot of balance in the market. The overall certificate balance remain quite high up to the current figures. So based on the latest iTrack data, we kind of estimates that around 5.1 terawatts hour of certificates remain unredeemed in the market, dominated by solar and wind, which account around 80% of total supplies in the market. So as I said before, the primary driver for this is the rapid expansion of the renewable energy capacity. And the larger generation base growth in 2025 actually increased the IREC issuance in the market. And technology consideration on wind and solar is heavily dependent on wind and solar is also playing a role because wind and solar especially account for the majority of new installations, and these technologies dominate IREC issuance. Although these will improve liquidity, but they also increase the risk of oversupply. And at the same time, we saw that the demand growth has not kept pace with the supply growth. Yes, we agreed that the voluntary corporate demand continue to grow, but actually capacity additions are growing faster. And to put pressure on price, buyers are also remain price sensitive and cautious, which further contributes to the pressure on prices. So from a pricing perspective, the Indian market since 2024 has seen quite a volatile trajectory. We saw that the prices at one time in 2024, actually in June to October, fell to around 40 cents, all-time low, mainly due to the oversupply conditions. And however, moving to quarter four 2024 and quarter one 2025, the market showed glimpse signs of recovery. The feedback that we received is because at this period of time, there's a tightening of supply that pushed IREC price higher up to Q1 2025. It marked the first increase since we first assessed wind and solar in Indian market since April 2024. And then by early 2025, we saw that the price had recovered at around 50%. And actually, the main factor was in September 2024, after IECX was appointed as the sole local issuer. The market feedback that we received said that the issuer had tightened the issuance controls to prevent double counting with RECs and PPAs, and some of the asset owner reported to us that some of the projects are not being approved as well. But that was minimal in terms of capacity. And we saw the slowdown of issuance persist for a few months in quarter one 2025. So by early 2025, we saw that the suppliers, which is generators, developers, and as well as IPPs, told us that they had adapted to the new issuance process. So this allow a faster and more efficient issuance because they can expect they know what to expect from the documentation and the process. And on the supply side, several generators and IPPs had depleted inventories in quarter one 2025 that keep the price stable. However, we saw that after March 2025, the market returned to quiet conditions because corporates completed their financial year 2025 and 2026 redemption cycles. And we saw that during this period, price gradually declined up until end of December 2025 here by around 50%. So it lost around 50% in value for current year vintage, which is V25 at that time. And then price then remained quite stable at around 50 cents each ish until December 2025. And moving into 2026, we saw that the demand began to pick up again during December and January. And at some point, we received a lot of feedback that spot vintage 2025 faced supply constraints, especially in December to January, before the price softened back down from 58 cents to 50 below 40 cents, 54 cents in February to March, sorry, because inventories started to return to the market. So in overall, the Indian Iraq price in 2024, 25, and 26 shows quite a predictable pattern. Earlier, start of the year, there will be a recovery in price due to renewed demand from corporates, and mid-year, there will be a slowdown in demand, and the price will decline. And by the end of the year, the demand will pick up again with the expectation of spot supply constraint in the market. So this movement reflects the quite straightforward driver in the market dynamics for Indian Iraq markets that only respond to supply conditions and corporate procurement cycle, new issuance framework rather than external factors compared to other markets. So key factors, so I would like to conclude the feedback that we received in 2025. So the first one, the corporate buying activity and delete decisions due to BPPA announcements, proposals, and the CCTS announcements muted the demand for a while. And supply constraint and inventory management by generators and IPPs moved the price as well. And then the enforcement of market rules by ICX also influenced the market, and backlogs of demand and the seasonal timing of corporate redemptions heavily influenced the price. And let's now take a closer look at REC price dynamics in Singapore. So unlike India, it's quite contrast. The Singapore market is more influenced by external and structural factors. So as we can see from the chart, the back in 2024, Singapore IREX were trading around Singapore dollar 90, and by 2025, it lost around 72% of its value, trading at around Singapore dollar 20. And the downward trend began around March 2025 actually. And if you zoom in on the last 6 months of 2025, the drop become even more pronounced. Yeah, for example, Solar 24 vintage declined by more than 90%, while as mentioned, B25 declined by around 69%. And then we also see a seasonal slowdown in the second and third quarters, which typically due to the corporates complete their sustainability reporting cycles in March. And uh, we saw a structural oversupply in the market, or structural price decline in the market throughout 2024 up to this year. So because of that, we go into the market and ask into the market what's happening and why this happened. So we can conclude that the feedback that we receive from the market, the first one, the corporate procurement strategies are shifting. So based on our feedback from Singapore, many companies are moving away from unbundled Iraq as well, and focusing more on bundle solutions such as PPA and VPPAs. That's what we hear from a lot of generators and PPA. A lot of generators and project developers are saying that their existing customer pool started to inquiring about PPA. So there's quite a notable shift there. And for example, last year, Microsoft and Amazon are exploring long-term PPAs in Singapore. Google already signed a 10-year waste to energy PPA. So a lot of data centers had shifted to PPAs. And these types of long-term arrangements reduce the need for unbundled IREX in Singapore, which quite kind of natural, putting pressure on the certificate price. And another minor factor that we receive is financial pressure, particularly on the exchange volatility. So according to participants, especially trader, that the buyers are quite sensitive in terms of fluctuations in foreign exchange. We saw that in May 2025, the volatility is the highest compared with annual average. So this volatility affects trading sentiment according to trader and risk perception as well, which has put pressure on reg demand. And the third factor is quite a big one. It's actually cross-border imports because in Singapore, unlike India, it's under the Singapore Standard 673. Cheap, it's allowed for corporates there to import cheaper racks from Vietnam, Malaysia, and Thailand, and that will be eligible for redemption in Singapore. Last year alone, it's estimated around 70% of redemptions currently come from Vietnam in Singapore. So although these certificates, we know that it's not recognized under the RA100 framework, but they are accepted under the local standards. So it's give buyer a lower cost alternatives and reducing the competitiveness of Singapore issue IRAC. And we hear feedback from few corporate buyers that they actively bought Vietnamese IRAC because of the cost itself, not the quality. And then we saw in 2000, the market dynamic has shifted in 2024. We saw that the market was largely buyer driven. And then by 2024, the situation had shifted. Sellers had to chase buyers, reflect a clear oversupply situation in Singapore market. And yeah, so overall, several factors are converging for Singapore market. Unlike Indian market where the driver are mostly internal factor that influence the price, but Singapore is the combination of internal and external factors. The first one I wrap up again for all of you: the shifting procurement strategies towards PPAs. The second one is the forex volatility, cross-border reg imports pressure the price as well. Other broader or economics cost pressure, macroeconomics pressure from the external geopolitical tension and tariff as well. And the regulatory flexibility under Singapore Standard 673 also indirectly put pressure on become a competition to the IRAC, local IRAC, apart from BPPA and PPA. And finally, I would like to touch on Malaysia. Let's look at Malaysia because Malaysia is quite similar, show a similar dynamic to Singapore, largely due to the growing adoptions of PPA. And this trend could also serve as a base point, reference point, like I said before, especially if PPA and VPPA markets become more mature in India in the future. So the in the Malaysia market, we have seen quite a notable shift in the interest toward direct PPAs under CRESS program, which has started to put pressure on unbundled spot prices in 2025. So it's supported by the data from our analytics team that conclude that the cost for the buyer to buy brown power plus unbundled IRAC is almost quite equivalent to the PPA price due to even though the striking price is quite high. So that kind of act as a competition to unbundled IRAC. Yeah. And the price was pressured throughout 2025. For example, we saw that V25 solar declined around 32%, and demand has also relatively quite weak in 2025, particularly for solar IRACs. And participants also said that other external factors such as US tariff and then it muted some corporate interest, and then older vintage also tend to lose value. So on the Malaysian market, we saw that a lot of buyers are quite interested in the previous year certificates because of it's quite cost competitive. And on the supply side, a lot of new market entrants have increased the certificate availability in the market, so adding further pressure on prices on top of the factor that I mentioned before. Like I said, buyers are also becoming increasingly price focused, with many favoring large hydro as well over solar or biomass as well due to lower costs. And at the same time, the rise of CRESS program and direct PPA deals, creates direct competition for unbundled IRAC. Actually, CRESS was announced in mid 2024, with the implementation gradually ramping up through 2025. So following the announcements, many corporates anticipate that the benefits of the program and begin shifted towards long-term PPA in Malaysia. So this wait and see approach kind of trade off the demand for unbundled IREX at one point, particularly in the second half of 2025. So overall, Malaysian market is facing price pressure from several factors. The shift towards direct PPAs under CRESS, relatively weak demand, overall weak demand, and increasing supply due to new market entrants. On the CRESS side, at the same time, a great market participants said that greater regulatory clarity around CRESS will help markets to stabilize and structure the market going forward, because there's a lot of uncertainty in the market. So that concludes my presentations today. So in summary, in markets like Malaysia and Singapore, PPAs and VPPAs increasingly compete with unbundled IREC, which explain why price in those markets have been under pressure and quite following the same trajectory, which is downward trajectory throughout few years. And cross-border REC supply also plays a role in adding competitive pressure, especially in Singapore. So Indian market behave quite differently. In contrast, the Indian market remains quite localized, where unbundled IREX continue to be one of the most practical procurement options, because there's limited the other options such as PPA and VPPAs. VPPAs is not here yet. PPAs is not that attractive in terms of flexibility and cost, according to fuel generators. So for many RE100 companies operating in India, according to the latest data, IREX remain attractive, and unbundled IREX is being used the most by RE100 company in India to offset their scope 2 emissions. That's all from my side. Thank you so much. Yep, that will end my presentation. Yeah.
Thanks, Afiq, for your insights into the Indian, Singapore, Malaysian IREX commodities. Before we move to the next session, I have a query with you, Afiq. Like for Indian market point of view, majorly the demands come from wind and solar techs, right? How do you see the demands for other technology like wise for waste to heat recovery or biomass? How does it goes? Do you see any updates onto that, or is it confined to wind or solar only? How do you see
Okay.
that?
So in India, we saw that there was a shift from hydro to biomass and WHR. So biomass and WHR cater a different buyer segment. I think the audience here will know more. So actually, the most of the buyers for biomass and WHR, if I'm not mistaken, according to market, is from the BRSR reporting. Yeah, voluntary reporting, that don't care that much about cost, about quality. So all of these demands had shifted to biomass. So biomass and WHR has its own target segment. It was the hydro buyers from the past, and wind and solar. Uh, Wind and solar will remain attractive to the RE100, especially commissioning date less than 15 years, because it's needed for a more stringent requirement under the RE100. Yeah.
Right.
So yeah, it behaves quite differently, but it has its own buyer segment between those technologies. Yeah. So the main issue, or the main factor that will affect the price, the demand had proven it always grow since past few years, but the thing is, there's more issuance in the market. The demand, the redemption grew by 60% year on year, but the issuance, the redemption grew 60% year on year. The issuance grew by about 64 to 65%, if I'm not mistaken. So it outpaced the redemption. That caused there's a balance of certificate in the market that caused the price to be pressured. Yeah. So that's the main issue. But else, the demand is quite healthy, I would say. Yeah, a lot of redemption is happening in the Indian market.
Thanks for answering my question. So before we move to the next session, I would request the attendees, if you have any queries, questions, you may please write it down into the Q&A chat box. So now over to you, Anirudh, to take us down the voluntary carbon markets.
Thanks, Nitu. I'll just share my screen. Please let me know if you can see my screen. Yeah, thank you so much. A very good evening, everyone. Thank you so much, Proclaim, for having us in this webinar to discuss the IREC and the voluntary carbon market with special focus on India. My name is Anirudh. I'm based out of Delhi. I am working as a senior price reporter covering the APAC voluntary and compliance carbon markets. And like my colleague Afiq mentioned previously, we are a price reporting agency in that we are not active participants in the trade market. We are not involved in any transactions in any capacity. We reach out to market participants, we gather market information, we assess prices, and we publish reports. So our main aim, our main function in the market is to bring more transparency in the market. Since we are third-party entities, we come with no bias, and we strive to bring in more transparency in markets as much as we can. So starting with my presentation, like most of you all know, I just wanted to give a brief overview on what are the factors that impact a voluntary carbon market credit prices. So as you all know, voluntary carbon market, unlike the domestic compliance markets, is quite global in nature. There are a few private standards that issue these credits after due diligence, after a due process is followed. And these project developers then sell these credits in the market for companies to purchase so that they can mitigate these credits against their emissions. This has been a system that's been in place for quite some time, even if we talk about the CDM and then the private standards that have come up. And now, since the market is in transition towards the upcoming 6.4 market along with the 6.2 component within Article 6. So these markets is what we closely look at. And my colleague Afiq looks at the IREC market, and my team and we look at the carbon credits market. As you can see on the screen as well, so these are the different parameters that influence prices, and we assess prices across the voluntary carbon market, across avoidance and removals. We take all of these factors into consideration. We have something called as a specification guide, which basically talks about what volume band, what vintage, what geography location, what is the type of technology, and what are the standards that are taken into consideration to be considered for the assessment. And this, judgment, this decision is made on the basis of how fungible a particular credit is. And we take all of this into consideration. We strive to provide all this information to our subscribers. As I mentioned, since we are here to provide as transparent an information as we can, we ensure that we provide all of these information in something called as HERDs that we put out on a daily basis from Monday through Friday. And these are the general factors that impact voluntary carbon credit prices at this point in time in the market. And as you all know, broadly speaking, the market is divided into avoidance and removals, with more preference now emerging for removals and a slight aversion from buyers for avoidance credits. So just wanted to take you all through this brief overview of what we consider in assessing our prices, which is reflective of what the market themselves take into consideration while purchasing or selling credits. And like I mentioned, so these are the prices that we have. You can see a lot of these prices are segregated based on different regions. And since my team and I are based out of APAC, we have a few prices that are very APAC centric. For example, the nature-based avoidance Southeast Asia that covers all of the major projects, which I'll be talking about going ahead in the presentation, which covers major projects in the Southeast Asia region, falls under the APAC team within the voluntary carbon market that is split between Gurgaon, London, and Houston. So we have a team in London and Houston as well, and they have their own price assessments. For APAC per se, we have the renewable energy price, the Biochar India price, the blue carbon price, and the nature-based avoidance Southeast Asia price. Besides these, all of us, also work towards reporting on Article 6, the Indian carbon market developments, and CORSIA market developments. So these are a bit of like team agnostic, if you can say, in that all the members cutting across these three regions work on these segments. So this is just a brief overview of all the prices that we cover. And we're happy to talk about this in much detail. We can get in touch after this webinar as well. And now coming to the trends that we are seeing in the voluntary carbon market. Like I mentioned, there are these two broad, segregations in the market with regards to avoidance and removals. Avoidance predominantly, the visibility is for renewables and cook stoves. So both of these segments, India has been a major player in both these segments in terms of production of credits. India has been able to export a lot of these credits in the market globally up until recently, up until 2023. And the supply and the demand and the fundamentals have weaked, have gone down a little after 2023, after the emergence of the CCP tags, the integrity issues, the additionality issues that have emerged in these segments. However, there is still a lot of demand for these segments from traditional buyers who are still looking to purchase any of these renewable and cook stove credits, especially for large volumes, for not so much of price increase, or for not for so much of older vintages. There are still buyers who are willing to purchase these credits in the market. And as you can see, the avoidance prices, the maximum price that we are seeing in the market for nature-based avoidance is at $11. And like I mentioned, each of these segments, reflects the most fungible credits that is there in the market. So the $11 is reflective of the most fungible credits, which is at this point in time from the Katingan project in Indonesia. And similarly, if you talk about removals, I'm also glad to talk about how India is emerging as a biochar production hub, with a lot of developers looking at or actually setting up projects in India, and they're trying to seek funds and sell into the global voluntary carbon market, with buyers mostly concentrated in the West. So this is like the main trends that are going on in the avoidance and removal space. Demand for avoidance, especially renewables and cook stoves, is diminishing a little. I wouldn't say it's completely gone out of the table. There are still some traditional buyers who are interested in purchasing these credits. The next most preferred credits in the avoidance space is the nature-based credits, and even within nature-based segment, the high-rated projects are what has a lot of takers in the market. That's where buyers are interested in purchasing. And eventually, the new entrants, the big tech giants based out of the US, are looking at much higher engineered removal credits, just so that they're able to mitigate a large chunk of their emissions that is emitted from the data centers. So this is how the market, the voluntary carbon market, is spread at this point in time, and people are waiting to see where the avoidance segment is actually headed, not just in India but globally as well. With a lot of projects in Africa also seeking to tap into the CORSIA and the Article 6 routes. People are waiting to see what is the future like for these avoidance segments, and what preference do buyers have for these credits going ahead. And like I mentioned, so for the nature-based segment, especially with Southeast Asia, we've launched these prices on March 2nd to reflect the granularity that people are seeking in the market. So each of these projects have different fundamentals, have different supply-demand dynamics, buyers have different preferences for credits from these projects. So just because all of these are nature-based, fall under the broad spectrum of nature-based avoidance, we've observed that that preference from buyers is not uniform for all of these credits. Certain credits are going at much higher premium. Certain credits are being traded at much lower levels. So because we wanted to reflect all of these discrepancies in the prices, because we wanted to show the differences in the prices, we've launched these prices on March 2nd. And like I said, since our aim is to bring as much transparency as we can, by introducing these different prices, we are pinning it down to the most granular detail that is possible to get out of a PRA. And that's what we're striving to do over here. And as you can see, like I mentioned, we have this volume range, the vintage, and delivery. Of course, we assess prices for spot delivery. So we take all of these information into consideration to assess prices for all of these projects. And going ahead, this list is also quite dynamic in nature, in that when we see more fungible projects come up, not just in India but across the APAC region, we'll keep making more and more additions to this list. Or if the market demands, perhaps if there is not much of a movement or traction for any project, we might also remove some of these credits, some of these projects from the assessment. And at this point in time, I also want to mention that we don't take an average of any of these prices. Each of these prices is standalone. We assess prices for each of this based on their own individual supply and demand dynamics. None of this, it's not a basket price. So each of these price reflects the project that it's mentioning. that it's mentioned against. And yeah, so going ahead, yes, we want to see how these prices turn up, how the supply and demand dynamics for each of these projects influences these prices going ahead. And talking about avoidance, so this is the renewable energy price that we assess out of India, and these prices reflect credits that are generated from India with a 2023 vintage, especially for wind and solar technology, for the gold standard certified credits. Having said that, so this is the parameters that we take into consideration for assessment. But having said that, if we are required to report on other prices, on other specifications, we do that as well, but just that we don't consider that for the assessment. Talking about the trend for renewable energy, so in 2024, second half of 2024, ICVCM came out with its decision to not provide CCP tags to any of the methodologies for renewable energy, which further hit sentiment because of this concern among participants of additionality for renewable energy credits. And this is what we've been hearing from the market as well. So since then, we've seen a bit of a downward spiral in prices. Like I mentioned, some traditional buyers still exist who are willing to purchase, though at large volumes or small volumes or whatever it is. There's still some buyers who are willing to purchase, but the new entrants are looking at much highly rated nature-based or the highly priced biochar credits in the market, just so that they're able to mitigate a large chunk of their emissions. Cookstow at least has a bit of an avenue in terms of tapping into the CORSIA and the Article 6 market. Of course, not from India, but from elsewhere in other global south countries. For India, the scope for renewable energy, other than the VCM market, is the battery storage component that the Indian government is pushing towards under the Article 6.2, or even the Indian carbon market that is coming up. So this is where India is. It's been a traditional supplier. There are still a lot of supply that is in the market. People are sitting on large inventories and they're looking to liquidate a lot of those credits. Prices are being on a downward spiral, but with a little bit of silver lining in this market is that issuances for the newer vintages is slightly on the lower side. So people are expecting this could support prices going ahead, but we need to see to what extent will this support sustain in the market, and to what extent will actually prices be at elevated levels if at all people see prices go up for the newer vintage. It remains to be seen how this market pans out and how any of the existing developers are able to tap into the newer markets that emerge going ahead. And of course, biochar being the most talked about segment in India at this point in time, with a lot of agriculture biomass discards that are available in this country. A lot of people are thinking of setting up projects, but the only catch is that it's quite a capital intensive affair to get into, with your machines, with your labor costs, logistics, getting your biomass feedstock, and then ensuring that the biochar is then sold in the market. So there's just too many moving parts, too many levers that a developer has to look into to get the project up and running. Despite that, there are several project developers who are setting up projects, who are signing deals with buyers in the West. Although all of those deals are being signed for forward deliveries, we assess prices for the spot market, and we have this idea. We are foreseeing a situation where liquidity in the spot market might perhaps improve, at least in the second half of this year, with some projects starting to issue these credits. Even though a large chunk of these credits will be used to service their forward agreements, we expect some of the residual issuances to come into the spot market and eventually, weigh down on prices a little, just so that it becomes more affordable for a many buyers in the market, and then eventually that will improve the liquidity in the biochar market. At this point in time, the liquidity is a bit of an issue, since there are not many developers are issuing or are supplying into the spot market. Buyers are getting into forward agreements, and there are several mechanisms that developers are trying to get into, by contracting a chunk of their credits to investors themselves, by trying to seek the buyers to get to try and get buyers to invest in their projects, to bundle some of the credits from one or two projects and then sell them to buyers, just so that the load on the individual projects reduces a bit. So these are some of the challenges that are there in the market that people are trying to maneuver around. Biomass feedstock is also a major issue that a lot of people are facing. There are agri processors, there are farmers who are willing to provide these biomass feedstock. But the thing with biochar production, as most of you all know, is you need to have a constant, continuous and round-the-clock supply of this biomass. And relying on just a handful of farmers or a handful of agri-processors wouldn't work. They need to have a diverse pool of biomass feedstock suppliers just so that the operation keeps running uninterrupted. So this is what's happening in renewables and biochar, and India is already positioned as a major supplier in the renewable space. It is quickly emerging as a major supplier in biochar and other tech-based removal projects as well. And now coming to the Indian carbon market, as most of you all know, the government or the administrator for the Indian carbon market has announced previously that they are expecting the maiden transactions, maiden trading activity to commence from October this year. So March 31st is the deadline for the first compliance year, which began on April 1st, 2025. There have been several developments over this year with a lot of these compliance entities receiving their final targets, except for iron and steel. They haven't received their final targets yet. But other sectors, like your petrochemicals, paper, and aluminium and chloralkali and cement have all received their final targets. So they'll get down to business to see what is their emissions and how much of it can they account. And based on their actual emissions against the targets they've been given, they'll either receive these certificates or they'll be, they'll have to, go out there and purchase these credits for trading. And one good thing in the market is that the trading is expected to happen on the Indian Power Exchange or the Energy Exchange, if I'm not wrong, which will give a lot of transparency to all the participants in the market. Which will ensure that a lot of people know where the prices are and at what levels the prices are the credits are being dealt at. So, like most of you all know, the compliance and the voluntary aspect of the Indian carbon market, with the government now expected to come out with methodologies and project registrations for the offset scheme as well. So there is still a catch in the voluntary carbon market, which I'll touch upon very quickly before I talk about the procedure. So like you can see, two entities that are in the market, based on their emissions against the targets that they've been given, whether they keep their emission below the target or exceed the target, they are liable to either purchase or they stand a chance to get these credits, and then it's traded on the power exchange. And entities that wish to bank these credits can also bank them for an unlimited time frame. It is still not mentioned by the Indian government on what is the time frame that they can bank these credits for. But as of now, as things stand, they can bank these credits for an unlimited time. So this is for the compliance scheme. This is how the compliance scheme is expected to unfold in this country on the power exchange, and we are hoping to see all of this commence from October onwards, when the entities will submit their emissions to the government, and the government will take a stock of the situation and then accordingly and subsequently provide them credits in the market. And like I said, so for the offset scheme, if the offset entities are expected to come up with credits, the government has not provided them an outlet at this point in time, in that compliance entities, as things stand, there's no clarity if compliance entities can purchase these credits to mitigate their emissions. So one possible outlet for these entities is to sell into the Article 6.2 or Article 6.4 market, provided the government provides them corresponding adjustments, LOAs, and they sign the authority to give away those credits for the host country. And these, as you can see on your screen, these are the methodologies the government has come up with. Again, this is not a final list. The government is still working on a few other methodologies, and they're expected to announce a few more methodologies cutting across other segments, which will be beneficial for Indian developers. And the India-Japan JCM that was signed, I think last year, should also provide a much required stimulus to the Indian developers in terms of an additional avenue for them to sell their credits under the 6.2 bilateral agreement with Japan. So with that, I would like to bring my presentation to a close. Happy to take any questions and discuss the market in depth going ahead as well.
Yeah, thanks Anirudh for these insights into the voluntary carbon markets. Before moving ahead with the Q&A session, I think Ms. Manisha, she has raised some hands. She wants to ask some questions. Please go ahead, Ms. Manisha. Graha, if you can check that. From the attendee, someone was asking a question.
We've granted access to speak, but she's on mute. So, you can drop the question in the Q&A box, and we can get your question, Manisha.
Yes. So in the meantime, I would like to thank both our speakers, Mr. Anirudh and Mr. Feek, for having time and going us through the insights of the IREC and the voluntary markets. So for our attendees, I would like to, discuss and tell a little bit about Proclime, what Proclime does. Many of you are aware also, but let me do a recap that with Proclime, we are active into carbon project developments. We are active into nature-based solution projects, into biochar. We are also active into trading for the voluntary carbon credits, also for the IREX, into the Asia Pacific region. Also, we do advisory services. So if you are looking forward for these services, we are very much happy and we can collaborate on this. So now moving ahead with the Q&A session, we have got one question that I wanted to understand what will be the prices of IREX from the wind solar V26, and will the prices will peak from V25 volume or any hindrances observed from the project proponents? So for this, Afiq, I think you have already answered with the pricing and everything, that with the volume, what will be the pricing. And for the hindrance that you are asking from the local issuers, so as per as the documents are correct, all the details are correct and no double accounting, there isn't any hindrance from the local issuers. Apart from this, I could not see any other question. And Ms. Manisha, if you want, you can drop your queries over here. We would be happy to answer. So if there are no questions further, we can end over here. And attendees, you are more than welcome for any other queries. You can reach out to us. We can answer also even after the webinar. So yeah, thanks again, Afiq. Thanks again, Anirudh, and for the attendees to attend this webinar. Thank you so much.
Thank you.